Hello everyone. We are aware of what's happening in the Middle East and the volatility it has caused in the market, and a lot of investors are on the edge from the residential investment portfolio side or even equity side or bond side. The outcome is very clear. The oil prices are going to increase. There will be a shortage of fuel in the near term. However, there is one area where many people are not focusing because they don't understand what is happening. And Japan is one such area where I want to highlight. Japan has already imported inflation. Bank of Japan has interfered with increase in base rate to 0.75%, and this country has been heavily dependent on importing energy. Because of this, the 10-year yield has surged to 2.5%, which is the highest since 1997, that is 3 decades. So during 3 decades, Japan has experienced a zero and even in some years a negative interest rate. And a lot of traders took an advantage of it by borrowing in Japanese yen and in that country and investing abroad for higher yields, getting extra rate of return. So that was their profit. And this entire concept is called yen carry trade. And in yen carry trade, when the interest rates in the home currency Japan increases, it then certainly impacts the return which traders are expecting, and that can lead them to go back and repay the yen borrowing, which might create an equity sell-off because the entire currencies which were borrowed in yen were invested in equities in United States or UK. So one such instance in the latest example is the shock of August 24, where there was a 6% correction in just 2 days, and it was probably one of the worst trading days of 2024 year. The second is capital repatriation. A lot of pension funds in Japan, they have invested abroad, in US being one of the biggest beneficiary of this, and comes UK next. Now, when capital repatriation happens back to the home currency, because Japan is offering 2.5% for a 10-year bond, why would someone go and invest in US or UK despite they are offering 4%, but then there is a currency depreciation of yen as well, right? So this capital repatriation can create a massive yield spikes in US and UK itself. Can you believe this? So overall, the impact of this can lead to a bond shock. There will be increase in the yields of many developed countries, because if there is an increase in the yield in United States and UK, which are considered to be the best of financial markets, now there are other developed countries even where Japan has invested, and now they would also have to offer a higher yield so that Japanese investors don't fly back their capital to their home markets. So this can create a contagion risk. And as I said, August 24 was one such example which can repeat again. And the impact of this is a higher cost of borrowing, which you have to expect in 2026. And that demands higher discipline in cash flow management and debt management, because if you're having any additional borrowing or you plan to take additional borrowing for new projects, it has to be carefully monitored. A proper investment appraisal has to go through, and that is what I anticipate in 2026. Not an investment advice, do your research, but overall this is what is happening in the market, and hope this is useful whether you're a student, an asset manager, investment manager, or you're managing a portfolio of your clients, or you're working in any treasury department of an MNC. This video is for you. Thank you so much for watching.